In 2025, the electric vehicle scoreboard reveals a paradox. BYD, the Chinese EV maker, is selling far more cars than Tesla, yet Tesla's market value towers above its rival. In the first half of 2025, BYD sold about 2.15 million vehicles, nearly triple Tesla's roughly 0.78 million in the same period. For full year 2024, BYD's sales, including plug-in hybrids, reached an estimated 4.2 million units, more than double Tesla's output. This volume advantage has translated into higher revenue as well. Over the last 12 months, BYD generated about $118 billion in sales, roughly $26 billion more than Tesla. Despite BYD's lead in units sold, and even a slight edge in revenue, the stock market treats these two companies very differently. Tesla's market capitalization in 2025 hovers around the $1 trillion mark, while BYD's is on the order of $130 to $150 billion. In other words, Tesla is valued at 7 to 10 times the value of BYD, an almost unbelievable gap given BYD's greater sales. Even their profitability metrics aren't worlds apart. In the first half of 2025, BYD's automotive gross profit margin was about 20%, actually a bit higher than Tesla's 18% over the same period. BYD's net profit margin was around 4.2% versus 5.2% for Tesla, both solid if unspectacular in the auto industry. With sales volumes and margins in a similar ballpark, how can Tesla be worth so much more? The answer comes down to two very different philosophies of making money, almost like two distinct religions of profit in the EV business. One preaches high margin and tech-fueled profits per vehicle, Tesla's creed, while the other seeks high volume and industrial scale as the path to success, BYD's creed. To understand why a BYD is not a Tesla, we must delve into these dueling playbooks of profit. Tesla's business model is built on the gospel of margin, the pursuit of high profit per vehicle, often at the expense of market share. In many ways, it mirrors Apple's playbook in smartphones: focus on premium products and cutting-edge tech, sell at hefty margins, and build a brand so desirable that customers pay top dollar. Apple famously has only about a quarter of global smartphone unit sales, but collects a disproportionate share of the industry's profits. Likewise, Tesla has positioned itself not just as a car manufacturer, but as a technology and luxury brand, enabling it to price its vehicles higher than competitors and still have eager buyers. The company spent years deliberately avoiding the low end of the market, instead cultivating an image of exclusivity and innovation. Its flagship models, the Model S, Model X, and even the mid-range Model 3 and Y, were priced with premium aspiration in mind, often with waiting lists of customers ready to pay. Until very recently, Tesla also shunned traditional advertising, relying on word of mouth and brand mystique. The company had essentially a $0 marketing budget, unheard of in the auto industry. This strong brand has given Tesla pricing power that most automakers could only dream of. Crucially, Tesla aims to maximize per-unit profit by packing its cars with high-margin software and features that it can monetize. The best example is Tesla's full self-driving FSD software, an optional package that currently costs customers up to $15,000, or around $199 per month via subscription. The beauty of FSD from a profit standpoint is that software can be sold over and over at very little marginal cost. Once Tesla develops a new self-driving feature, deploying it to another car is almost pure profit. Indeed, analysts note that FSD revenue is highly margin accretive. In plain English, each dollar of FSD sales adds almost $1 of gross profit. Tesla has already accumulated billions in deferred revenue from FSD pre-sales, money paid by customers for promised self-driving capabilities that are still under development, a sort of profit in waiting on its balance sheet. As the company rolls out more FSD features, like Auto Park or Smart Summon, it gradually recognizes this deferred revenue, giving periodic boosts to its earnings. This unique model, sell software today, deliver it, and book the income tomorrow, means Tesla can earn far more from a car over its lifetime than the one-time sticker price. Tesla's pursuit of margin is also supported by vertical integration and direct sales. The company operates its own showrooms and online sales, with no dealer middlemen taking a cut. It builds large portions of its cars in-house, from battery packs to infotainment software to even designing its own AI chips for self-driving. By doing so much under one roof, Tesla both cuts costs and keeps more of the value add, boosting its gross margin. It's no coincidence that at its peak, Tesla's automotive gross margin was 25 to 30%, roughly double the industry average. Even after recent price cuts, Tesla's margins remain among the highest in the auto sector, about 17 to 18% in mid-2023, down from approximately 26% a year prior, but still well above legacy automakers that often see approximately 10% or less. This margin edge was achieved through a combination of premium pricing, economies of scale at its gigafactories, and relentless cost optimization, for example, using giant casting machines to simplify car bodies, or writing its own software to save on licensing fees. Perhaps the most defining aspect of Tesla's profit philosophy is its vision of the future. CEO Elon Musk has repeatedly signaled that Tesla is willing to sacrifice short-term margins in exchange for long-term dominance, if that dominance comes with lucrative software and services. The short-term variances in gross margin are minor relative to the long-term picture. Autonomy will make all of these numbers look silly, Musk said in mid-2023. He has openly wagered that accepting lower car profits now, via price cuts, will pay off later when Tesla can unlock full self-driving and potentially deploy a fleet of robotaxis earning revenue. In Musk's vision, FSD could one day account for most of Tesla's value, providing a profit stream that traditional automakers simply don't have. This is essentially the high-margin tech playbook. Get an advanced product into as many hands as possible and reap outsized profit on software or ecosystem services down the road. It's a strategy that asks investors to value Tesla less like a car company and more like a Silicon Valley giant. So far, they have. Despite recent dips, Tesla's valuation reflects expectations of extraordinary future margins from things like autonomous driving, AI, and energy software, rather than just the dollars it makes on selling cars today. Facing Tesla's high-margin creed is BYD's very different gospel of volume. BYD, which stands for Build Your Dreams, has built its business on the belief that dominating the market through sheer scale and breadth is the surest path to long-term profit. If Tesla is following Apple's footsteps, BYD is following a script closer to Toyota's: prioritize efficient mass production, capture market share across all segments, and achieve profits via economies of scale and ubiquity. BYD's strategy is to put an electric vehicle in every driveway that wants one, often by outpricing and outproducing the competition. In practice, this means BYD has been willing to aggressively cut prices and accept thinner profit margins in order to rapidly grow its sales volume and market share. A vivid example came in 2023 to 2024, when a fierce EV price war erupted in China. BYD slashed prices by up to 34% on roughly 20 models, a move that sent its vehicle gross margin down to 16.3% in Q2 2025, the lowest in 3 years, and even caused a quarterly profit drop of 30% year-on-year. On the face of it, that sounds like a dire outcome, a rare profit decline for BYD. But this was a deliberate sacrifice. Those price cuts turbocharged BYD's sales growth and expanded its market share lead. In fact, despite the hit to per-car margins, BYD's operating cash flow surged 125% in that period, and its cash reserves remain huge, over 156 billion yen, or approximately $22 billion. In other words, BYD is using its financial strength as a war chest to fund a land grab in the EV market, essentially saying, we'll make less profit on each car, but we'll sell so many more cars that we still come out ahead in the long run. Central to BYD's volume-driven approach is its extraordinary industrial integration and scale. BYD is not just an automaker, it's a battery maker, a chip designer, and a general manufacturer rolled into one. The company produces its own batteries, including the well-known Blade battery technology, and electric motors, designs its own power electronics and semiconductors, and even operates its own fleet of cargo ships to export cars. This level of vertical integration is arguably unmatched in the auto industry. It gives BYD tight control over its supply chain and costs. BYD can cut prices aggressively in part because it builds so much of the car's value in-house, saving on supplier markups and ensuring steady component supply. For comparison, most legacy automakers outsource a large chunk of their components to third parties. Tesla is more integrated than old automakers, but even Tesla doesn't make its own battery cells at the volume BYD does, nor does it fabricate microchips. BYD does both. This integration means BYD can profitably sell EVs at prices that might be break-even for others. It's no coincidence that BYD has been able to introduce truly affordable models like the BYD Seagull, a small EV in China starting around $10,000, price points Tesla has yet to touch, while still staying in the black. BYD's manufacturing prowess and scale give it a cost advantage that lets it thrive on thinner margins, very much like Toyota mastered lean production to dominate gas car sales in an earlier era. Another pillar of BYD's volume gospel is its broad, multi-tiered product range. Tesla famously maintains a fairly sparse lineup, just a handful of models targeting the premium segments. But BYD has a vehicle for every niche and budget. Under the BYD umbrella are multiple brands and sub-brands, from the main BYD brand offering mass-market sedans and SUVs, to the newer Ocean series of stylish mid-range EVs, all the way up to high-end marquees like Denza, a joint venture with Mercedes-Benz, and the ultra-luxury Yangwang brand, which sells six-figure halo vehicles like the Yangwang U8 off-road EV. In 2023, BYD even launched the tiny Seagull EV to go after entry-level buyers, while also unveiling the Yangwang U8 and U9 to burnish its image at the top end. This from-the-bottom-to-the-top approach is classic volume strategy. Use different models, and even different brands, to capture every slice of the market, leaving no gap for competitors. BYD wants to be selling millions of EVs across all price categories, much as Toyota sells everything from Corollas to Land Cruisers. The result? BYD can achieve massive sales figures, as we saw millions of vehicles annually, but by design, many of those sales are lower-priced models with slim per-unit profits. It's a high-volume, low-margin formula. This does mean BYD's overall profit margins are modest, on par with or below Tesla's, but it secures a dominant share of the customer base. BYD's leadership argues that in a fast-growing EV market, grabbing market share early, even at the cost of margin, will yield pricing power and scale efficiencies later on. Essentially, BYD is playing the long game of industrial scale. Get big now, and profits will follow once you're the last man standing in a consolidated market. We should also note that BYD's rise has been nurtured in the world's largest EV market, China. Strong domestic demand, along with government incentives for EV buyers and producers, provided a perfect runway for BYD's scale strategy. BYD rode a wave of Chinese EV subsidies for years, which helped it build factories and drive down costs. Those same subsidies contributed to a degree of oversupply in China's EV industry, triggering the price war we discussed. Even as subsidies phase out, BYD's momentum in China continues. It has a commanding share of Chinese new energy vehicle sales and has even surpassed Tesla in EV registrations in China as of early 2025. Now BYD is setting its sights globally, bringing its volume playbook to new markets. It's expanding sales in Europe, Latin America, and Asia-Pacific at a blistering pace, often entering with very competitive pricing to undercut local and Tesla offerings. In July 2025, for example, BYD's sales in Europe tripled year-on-year, reaching a point where BYD outsold Tesla in Europe that month. This international push, backed by BYD's capacity to ramp production, suggests that BYD intends to become to the EV era what Toyota was to the gasoline era, the global titan of auto volume. The gospel of volume has its risks, we'll discuss those shortly, but BYD's execution of this strategy has so far been highly effective. It is now the clear number one in EV sales worldwide. The contrast between Tesla and BYD is not just about two companies. It's about two fundamentally different playbooks for how to win in the EV industry. Tesla's playbook is that of a high-margin tech disruptor, and BYD's is that of a high-volume manufacturing powerhouse. These philosophies shape everything the companies do, from product strategy to investor relations. Start with how each company defines success. Tesla's ethos might be summed up as profit per car, and future potential, above all. Tesla would rather sell one car at a 30% margin than two cars at a 10% margin. This mindset comes straight from the Silicon Valley DNA. It's similar to how a software company or a premium electronics maker operates. By focusing on affluent early adopters and technology enthusiasts, Tesla built a base of customers willing to pay a premium. Each Tesla vehicle also serves as a platform for additional revenue. Owners can buy software upgrades, higher-tier connectivity, and other add-ons that have minimal cost to Tesla, but fatten its profits. This is why investors see Tesla less as another car company, and more as a kind of tech platform on wheels. The promise of recurring software income, from things like self-driving subscriptions or App Store-like services in the car, means Tesla can be valued at earnings multiples that traditional automakers could never justify. In short, Tesla's profit playbook emphasizes quality of revenue, high margin, tech-driven, potentially recurring, over sheer quantity of units sold. It's a bit like an elite sports car maker mentality supercharged with tech sector thinking, and it has clearly seduced the stock market. Tesla's valuation assumes that it will keep extracting far more profit per vehicle than anyone else, and perhaps layer on entirely new revenue streams, robotaxi services, energy services, etc., in the future. BYD's measure of success, on the other hand, is domination of market share. Its playbook could be phrased as win the volume race, and the profits will sort themselves out. BYD operates with a mindset more akin to a classic industrial titan. The company is proud of making things efficiently and in huge numbers. Batteries, motors, cars, even masks and electronics. BYD has a diverse manufacturing portfolio. BYD executives often highlight factory output milestones and cost reductions achieved through scale. Investor sentiment around BYD, accordingly, values it closer to how one would value a high-growth manufacturer. Strong revenue growth, heavy capital investment, and thinner margins by design. BYD is valued at a fraction of Tesla's price-to-earnings or price-to-sales ratios because the market sees it as an automaker first and foremost, just a very successful, rapidly growing one, whereas Tesla is valued like a tech company. This difference in investor perception is almost self-fulfilling. Tesla can raise capital more easily and enjoy a higher stock price because of its high-margin narrative, while BYD's lower valuation multiple reflects a degree of skepticism about its profit model. Investors worry about those slim margins. Yet BYD's fans would argue that the company's real economy strength, its ability to crank out millions of vehicles at reasonable profit, makes it a safer, more tangible bet in the long run. It's the age-old debate of visionary potential versus proven execution. Tesla encapsulates the former, a bet on what could be, while BYD exemplifies the latter, a bet on what is already being delivered. Operationally, the two playbooks lead to very different strategic choices. Tesla has kept its product lineup intentionally limited, just a few models, all in the mid to high end, with relatively few variants. This simplifies manufacturing, which helps Tesla's margins, and keeps the brand upscale. It's the Apple approach of a curated product line. BYD, in contrast, has proliferated models and sub-brands to chase every customer segment. That maximizes volume, but adds complexity to manufacturing and marketing. BYD must manage dozens of nameplates, from compact hatchbacks to luxury SUVs, ensuring each is cost competitive. This is more akin to how General Motors or Volkswagen run their portfolios, and it's impressive that BYD has done it while remaining highly profitable and efficient. The vertical integration both companies pursue also serves different aims. Tesla's partial vertical integration, making its own software, designing chips, building its supercharger network, etc., is aimed at creating a unique ecosystem moat and enhancing profitability per car. BYD's complete vertical integration is aimed at cost control and supply security, making sure it can scale production without bottlenecks or paying premium to suppliers. Both companies, in their own way, have moats. Tesla's is a technology and brand moat, its name recognition, software, and first-mover advantage in Western markets, while BYD's is a manufacturing and cost moat, its ability to build EVs faster and cheaper, especially in its home base of China. There's also a stark contrast in how each company approaches innovation and risk. Tesla is often willing to move fast and break things, to borrow a Silicon Valley cliché. It rolled out bold ideas like selling cars online, deploying beta self-driving software to consumers, using over-the-air updates to add features. All innovative, high-margin friendly approaches, but sometimes at the expense of reliability or immediate volume. For instance, Tesla's obsession with cutting-edge design led to well-documented production bottlenecks during the Model 3 launch. Elon Musk referred to it as production hell. BYD's innovation, while significant, especially in battery chemistry and vehicle design, tends to be more pragmatic and production-oriented. BYD, for example, focused on blade battery tech that improves safety and cost, a very manufacturing-centric innovation. When it comes to software or autonomy, BYD has not tried to leap ahead with grand promises. It generally adopts tech that is mature, for instance, using partnerships for advanced driver assistance rather than developing a moonshot self-driving system entirely in-house. This reflects a cultural difference. Tesla is willing to hype unproven tech to justify its margins and valuation, whereas BYD sticks closer to the nuts and bolts of making a better, cheaper car. Neither approach is inherently superior. They are just very different paths, each with upsides and downsides, as we'll see. No strategy is bulletproof. For all of Tesla's strengths, its high-margin, high-tech approach comes with significant risks and vulnerabilities. Likewise, BYD's volume-centric model, while powerful, has its own weak spots. A balanced analysis must consider where each religion of profit could falter. For Tesla, one major risk is that the company's sky-high valuation and margins are built on promises that could fall short. A huge portion of Tesla's market value rests on the expectation of future software-driven profits, especially from full self-driving capabilities, that are not yet fully realized. If Tesla's autonomous driving technology fails to achieve the level of safety and ubiquity that Elon Musk has projected, the rationale for Tesla's premium pricing and nosebleed stock valuation could evaporate. Musk himself acknowledges that he's betting on autonomy to justify Tesla's economics. He believes FSD can one day account for most of Tesla's value, effectively subsidizing cheaper car prices with software income. But after years of development, true Level 4/5 self-driving is still not here, and regulators are scrutinizing Tesla's FSD beta due to safety concerns after various crashes. If autonomy never lives up to the hype or remains a niche feature, Tesla could find itself having sacrificed too much margin, through price cuts, for a future that doesn't arrive. In essence, Tesla might be forced to compete more on the traditional auto terms of price and hardware, where its advantages are smaller. This would be a serious blow to the high-margin doctrine. Another Tesla vulnerability lies in the company's recent pivot to maintain volume. In 2023, Tesla initiated a series of price cuts, effectively waging a price war of its own, to protect its growth and market share, especially as competition in China and Europe heated up. This was a sharp departure from Tesla's prior strategy of raising prices to match demand. The result was a squeeze on Tesla's once enviable margins. By mid-2023, Tesla's automotive gross margin had fallen to about 17 to 18%, down from 25 to 30% a year earlier. While still healthy, those margins were approaching ordinary for a car company. This illustrates a key risk. Tesla's margin advantage can erode quickly if it has to compete on price. As more EV rivals emerge, from Ford to Volkswagen to a legion of Chinese startups, Tesla won't always have the luxury of pricing well above the pack. If, say, a competitor produces an EV nearly as good as a Model Y but significantly cheaper, Tesla might be forced to lower prices further, which directly undermines its profit per car ethos. In short, competition is forcing Tesla into a volume game that it traditionally tried to avoid. The company's challenge will be to innovate enough, in cost reduction and in features, that it can stay a step ahead without engaging in a margin-killing race to the bottom. It's a delicate balance. Tesla bulls trust that the company's lead in software and manufacturing will keep costs low and appeal high. Bears point out that Tesla's product lineup is aging. The Model 3 is now several years old, and competitors are narrowing the gap, which could further pressure margins. Tesla also faces some strategic and external risks. One is the reliance on Elon Musk's persona and decisions, which can be a double-edged sword. Musk's high profile and outspoken nature have undeniably boosted Tesla's brand. But his antics, such as erratic tweets or polarizing ventures like acquiring Twitter, can alienate some consumers and investors. There's evidence that Musk's reputation has dented Tesla's appeal among certain buyer groups in recent years. Additionally, Tesla's heavy dependence on the US for profit and China for growth exposes it to geopolitical and policy risks. For instance, Tesla benefits from US EV tax credits and state zero-emission vehicle mandates, and the sale of carbon credits to other automakers. If political winds shift and such incentives were rolled back, Tesla could lose some financial advantages. In China, Tesla has a large factory and market, but rising US-China tensions or a wave of nationalism could impede its operations or sales there. In essence, Tesla's strategy banks on a lot of things going right: rapid tech development, continued investor faith, and stable market conditions. If any of these pillars waver, Tesla's high-margin model could suddenly look precarious. The company's stock is often called priced for perfection, and perfection is hard to achieve year after year. Turning to BYD's risks, the challenges are of a different nature, more tactical and structural. The most obvious risk is that BYD's thin margins leave less room for error. When you're operating at, say, a 4 to 5% net profit margin, a spike in costs or a need to cut prices further can quickly wipe out profits. BYD is currently engaged in aggressive price competition in China. This has worked to boost its volume, but it's essentially a race of attrition that could drag on longer than anticipated. Chinese EV prices fell approximately 19% over the last 2 years amid the fierce competition. BYD is better positioned than most to survive such a war, given its scale and efficiency. But prolonged price wars can hurt even the strongest players. We've already seen BYD's gross margin get crunched to the mid-teens in 2025 due to these cuts. If competitors, backed by investors or government support, decide to sell at a loss just to gain share, BYD could face periods of earning very little per car, or even breaking even. In other words, BYD's profit engine can sputter if volume growth comes only via heavy discounting. The company needs to eventually stabilize prices or achieve even greater cost reductions to bring margins back up. There's a fine line between using low margins as an expansion strategy and getting stuck in a permanent low-margin business. BYD will hope that weaker competitors drop out, as is expected. Many of the 100-plus Chinese EV makers likely won't survive till 2030, allowing it to raise prices later. But that outcome isn't guaranteed on the global stage. Another risk for BYD is geographical and geopolitical concentration. Despite its global forays, BYD still derives roughly 73% of its revenue from China. That makes it heavily exposed to the Chinese economic cycle and policy environment. If China's car market slows, or if the government support that catalyzed EV adoption winds down too fast, BYD could face an abrupt demand or funding shortfall at home. Moreover, as BYD tries to expand abroad, it runs into political hurdles. Western governments are increasingly wary of Chinese technology exports, and the EU has launched anti-subsidy investigations into Chinese EV makers. Europe has proposed tariffs, around 10 to 20% range, on imported Chinese EVs to ensure a level playing field. The United States has gone even further, effectively banning Chinese-made passenger EVs via a 27.5% import tariff and excluding them from EV tax credits. BYD's cars can't currently compete in the US market under these conditions. BYD is mitigating this by setting up localized production, for example, building factories in Asia, considering plants in Europe, and focusing on hybrid vehicles that circumvent some tariffs. Still, navigating trade barriers will be a constant struggle. BYD might have to invest heavily to build vehicles in the markets it wants to serve, which could raise its costs and temper its volume advantage. The shadow of geopolitics means BYD's global volume aspirations are not entirely in its own control. Lastly, BYD's all-in volume strategy carries the risk of overextension. Rapid expansion can strain any company. BYD is launching new models at a torrid pace, constructing new factories, and entering new countries simultaneously. That presents execution risks. From maintaining quality control, will all those new cars be reliable and safe, or will BYD face recalls that hurt its reputation to managing supply chains in unfamiliar markets? Thus far, BYD has executed well, but history cautions that extremely fast growth can sometimes lead to mistakes. Additionally, BYD's relatively low profit margins mean it has less of a cushion to absorb setbacks. For instance, if a particular model underperforms or a new overseas venture runs at a loss for a while, BYD can't rely on fat profits from other units to cover it. Everything is run with a lean margin. Diversification is a partial safety net for BYD. It also makes buses, batteries, solar panels, etc., giving it some resilience. But the core auto business needs to keep running very efficiently to avoid financial trouble.